Welcome to the Bristol Real Estate Podcast. My name is Edgar Hakobyan, and you're probably not familiar with my face or voice because today I'm filling in for our great host, Margarita. But we're still going to provide you with the latest and greatest news, the hottest industry topics, and a lot of content that you can take away. Today, our guest is a great friend of the Pocket Network, co-owner of Option One Lending out of Sherman Oaks, California, Artin Fallahi. Thanks for coming back, Artin.
Hi, thanks for having me back. Good to be back.
So it's been almost a year to date. Our last podcast launched on March 11, I believe, last year, where we sat down and it was completely different environment, completely different setting as far as business goes, as far as economy goes, just a whole different scene. Sort of, let's reverse before we go into today's news. Let's reverse back to how your business was last year, and then bring it down to where you are today, and probably the most drastic changes that have happened.
Right, yeah. Thanks for having me back, and good to be with you. So last time when we did the podcast, it was still beginning of 2022, I believe.
Yeah.
Right, the market was still hot. The rates were starting to climb, but not to the extent where we saw towards the third and the fourth quarter of 2022.
Right.
So demand was still super high. Inflation was down, right? Inflation started creeping up around April, May, and then by mid-year, we started seeing the big impact of inflation. It was a completely different market. And then we kind of went through the cycles. We saw where inflation went and then how the Fed reacted, and then where we are now, which we'll talk about, I'm sure.
So remind me when the Fed stepped in and started raising interest rates once they saw this thing was going out of control last year.
Right. I think we've had 9 raises already.
9 consecutive, yeah.
Right. So it's been about a year almost. They've been raising. It started more mellow, and then they saw that it's not making an impact. So they started taking drastic measures where 75 bips, right?
Right.
Point or 0.75%. And they did several of those in a row. And inflation, they were trying to fight inflation. So
and obviously that has its cause and effects, right?
Right.
Their whole goal is to sort of press down on the inflation rate and get it to a certain number that they're trying to reach. But it also has its effects to it, right? Where as far as I believe Jerome Powell, in his statement a couple days ago, I think he reiterated about 10 plus times how the employment rates are going to be affected. So that's probably one big factor that that's going to be affected by the raise in the interest rates. Right. Obviously, we saw the big bank collapse, which we'll go into all of these. That was 2 weeks ago. And actually just yesterday, I think I was reading another smaller bank than SVB collapsed too. They had a bank run and the federal regulators took it over. So it's been an interesting year to say the least.
Right.
How have you personally adjusted as far as business-wise? Because obviously you're not killing it in refis right now. So
right, yeah.
What are you doing right now?
I was just gonna say, so at Option One Lending in particular, we're a very purchase centric lender, right? We don't go after refinances. When the refinances came, obviously it was a tremendous growth, right? We quadrupled in business over a span of a few months when COVID hit and the rates sank where we saw. We're very purchase centric, meaning we focus on realtor relationships, purchase market. So our purchase business is pretty steady. Obviously, no one has as much business as they did in 22 or leading to 21 growth, right? But because we're focused on buyers, there are always going to be buyers. There are always household formations we always talk about, right? There's always going to be people getting married. People always have to grow up. They have to move out of their households. They get married. They need a home.
Life,
they need a roof, right? Yeah. So there's always going to be household formations and not enough homes being built. And we live in a very desirable location, not just our state, but our particular MSA, right, and in Los Angeles. There's always going to be a shortage of homes unless there's a mass development, which we're not seeing.
We don't even have space to develop at this point.
Right, at some point you have to start moving north, like in our particular area in San Fernando Valley. You can see the new developers, the large developers, they keep moving to the north side of the valley. So it keeps going further and further north. because they're just not. We're between a mountain and an ocean, and on the other side we have some land to develop.
Right, and so two things came to mind. First and foremost, with obviously interest rates being so high and affordability just being at like all-time lows right now, and I saw a recent report where consumers, just average people's savings accounts were just completely getting depleted, and their credit card balances were skyrocketing, right? But I think California introduced like a new program where I guess they're sort of incentivizing people to buy. Sort of explain that.
Yeah, so CalHEFA, which is the California kind of an umbrella program that works in hand in hand with FHA sometimes, and also Fannie Mae.
Okay.
They have some down payment assistance programs, and recently. There's a new program called California Dream, which is a shared appreciation program where, in simple words, pretty much the state buys the house with you. They give you 20% of the down payment. This program will be launching very soon, so it's being prepped right now, and I think once the program comes out, we'll know more about it. But in a nutshell, they give you 20% of the funds that you have to buy a house. Let's say you're buying a $500,000 property, they'll give you 20% down, but now they own 20% of the property.
Oh, okay.
So at time of sale, time of refinance, they're co-owners with you, so you have to follow their guides, their rules, their limitations. And when you sell the property, let's say you had a gain of $100,000,
right?
Not only you have to pay back the state the original $100,000 that they gave you in assistance, but you have to now give them 20% of the profit.
Of the profit as well. So the capital gains, they has to go with it.
Right, exactly. So the owner, the buyer, maintains the property, pays the property taxes, the insurance does improvements, but then the state will take the 20%. So again, these programs are great for a segment of buyers, but not for everyone. It's not free money.
Yeah.
It's not forgivable. You have to pay it back, either through a refinance or sale of the property.
Now, so that's the interesting thing about it. It's like, obviously, California is probably one of the more expensive states in the U.S. Even though, there's plenty of jobs here. I'm sure the wages are a lot higher here compared to other states. But if I'm sort of falling back on this, if someone can't naturally come up with funds to purchase a house, right, as far as down payment goes, and monthly payments and maintenance costs and taxes and so on and so forth, you think long term those incentives will do damage as far as housing or the economy goes?
Right, that's always my concern, because let's say an average buyer who puts 10 or 20% down, they have more skin in the game, right?
Right.
An FHA buyer or a VA buyer or buyer under any of these down payment assistance programs, they have, first of all, you start with zero equity, right? Let's say if someone is giving you the down payment, you're already at 100% financing, right? Yep. So it takes much, much longer for your property to have enough equity for you to even be able to refinance, right? So you have to sustain this payment, especially at higher rates, for a period of time.
Right.
And because you didn't really put down your hard-earned savings, right? You have more reasons to walk away, right?
Exactly.
If things get stressful, you may say, well, I didn't really put much down payment. Maybe I can't afford it. Maybe I'm going to let it go, right? That being said, this is, again, we live in a very desirable area of the state, let alone the country.
Of course.
Inventory levels are super low. I've had number of escrows this past few weeks where doesn't matter if it's in Glendale, La Cañada, Sherman Oaks, Encino Hills, Studio City. All of these areas are all these neighborhoods are extremely desirable.
Right.
So even today with rates in the 6s and 7s, I've seen escrows with 30 offers, 15 offers, 12 offers, 7 offers, right? And the lower the price goes, the more competitive it becomes, because you're competing with more buyers. A $3 million home is not as competitive to purchase on the down market, down market, right? But a $700,000 house, you're competing with anyone and everyone who has 0 down, 3% down, 5% down, right? You're competing with a ton of buyers, and rents aren't helping. So rents have been climbing, and the rents are not affordable either. So either you have to buy and sustain a little bit higher mortgage for a while until your mortgage becomes more affordable because of a refinance, let's say, in the near future, or you have to continue renting, which has no benefits, right? It's
well, that's
so it's a tough place to be because affordability is super tough right now in LA.
Affordability is super tough, yes, in LA, which is just why the question arises, like, long term, what will be the effects of this, right? So, we're talking about interest rates rising and stuff. Let's sort of jump into the topic of we're about, I think, 2 weeks to date where the federal regulators took over SVB, or it's been 1 week.
It's been
March 10th, right? I believe.
Right, it's been about 2 weeks.
So about 2 weeks since federal regulators took over the 16th largest bank in the U.S.
Right.
And so we've gotten a lot more information now than we would have 2 weeks ago. And from what I've read and what I've seen, it's been a very interesting, to say the least, situation of what's been going on as far as their executive team and what the government did right after all this. So let's sort of jump into it and see. Now, my take on it, obviously now we know the government bailed them out, right? Reason being is I believe 97% of account holders had over the $250,000 FDIC insured limit. Reason, they're tech companies, a lot of payroll companies,
right.
Venture capitalist accounts. So very, very large fund. Now, my take on it is, if government went in there and like a big brother bailed them out, right? What happens when another one fails,
right,
and then another one fails, right? You're gonna just tell them, oh, we don't really care about
right.
you.
So
we just take care of them.
FDIC is a great safety net we have, right, in this country.
Yeah.
And the $250,000 limit only applies to your individual account, right? So, for instance, if you have your wife and children on your account, that limit goes up because you get $250,000 additional for another, let's say, your spouse.
Per account holder?
Per account holder, right? So if you add your wife's and then you add, let's say, another beneficiary, let's say your son or daughter, now that account increases to $750,000 protection. So FDIC is a great tool. The scary part about FDIC, and I never looked into it, and no one did, these things didn't come up until we have a failure, right? Unfortunately, everything was booming for 2 years. We're printing money. Yep. Government was injecting free funds into the economy. Right. No one was looking at what's
all steroids, basically.
Right, yes. Everything was on steroids. Housing, interest rates, loans, right? Everything was freely available very easily.
Which is probably one of the reasons why I believe in the past 2 years, specifically with SVB now, because we have their information, the deposits went up drastically. Right, yeah. Because of all this stuff.
People are holding a lot of funds. The VCs were drowning in money. Yeah, they didn't know where to invest it, right? There was, at some point, I think we had, if I could be mistaken, but a couple of years ago, at some point, VCs combined had over $1 trillion in funds that they didn't know where to invest. Wow. So the part of that about FDIC that's scary is that right now FDIC is an insurance company, right? So all the banks pay monthly dues. We really pay into it, right? Your depositor, in a way or in some way or other, you pay into it. So FDIC collects these funds, and then when a bank fails, they use that pot of money to pay the depositor. So right now they're holding about $145 billion in funds. It's a lot of money, right?
FDIC specifically.
FDIC specifically has about $145 billion in their pot. Wow. You know how much money they're insuring? All those $250,000 accounts?
How much?
$9.6 trillion. So they have some like 1.5 or 15% of. That's insane. Oh no, 1.5% of the funds that they need, they actually have. Wow. So if you have too many funds too many banks fail, that 145 billion is going to run out in a second, right? Because you're insuring almost $10 trillion, but you only have 145 billion in the account. So what happens is, if that happens, Fed or the Treasury has to step in. What are they going to do? They're going to print printing money, and then it's going to pump up the inflation again. So that's the scary part, because right now we're trying to fight inflation.
Yeah. That's the last thing we need is more printing going on.
Now, based on everything I've read, SVB really didn't do anything illegal, right? Meaning they were all management shortcomings. Now
maybe not illegal, but I'd like to say unethical at
absolutely,
some times,
yeah.
Right?
For example, a bank that size, and true, most buyers or most citizens haven't heard of SVB because it's a very
not
specific.
A normal place,
it's not a Chase or a Wells Fargo or a Bank of America, but 16th largest bank in the largest economy in the world is a pretty big bank. It's probably bigger than most banks in the world, right? So not having a risk officer for 8 months, it's unacceptable.
I wanted to mention
and that's a failure of the Fed, right? The Fed should have raised a red flag and say, hey, what's going on? How come you don't have a risk? And guess what the risk officer does? Risk officer every day looks at the funds that the bank has invested and says, hey, wait a minute, why are we putting 70% of our money into bonds? The bonds are worthless now.
What, like 1.8%?
Right, exactly. At 1.8, 1.7%. When the inflation was at 6.5%, you're investing your funds and you're giving away 3% returns on savings accounts, 4-5% on CDs, which is not unusual these days, right? So no one looked at that for months and months, where at some point where they hit a liquidity problem, they started selling these at a loss, the bonds that they had invested. And the bank should have never invested so much of their money in one place. They put all their eggs in one basket, and it was a really bad basket, right? 1.7, 1.8% return. So that was just a disaster about to. Now, if the Fed had never raised the rates, we would have never seen this. Meaning they would have continued on.
But because
Fed raising the rate devalued the bonds.
Right, but at a certain point, I call it being off when the risk officer leaves. I believe I have it written down here, April of 2020, and for the whole year, nobody was named as a successor, but she was paid on payroll until I believe like end of August or something. So something's like, that's already off as a company in that that large of a spectrum with so much money to handle and so many accounts and so many businesses to take care of. Like you said, the Fed should have stepped in, but also
there was a lot of red flags. Like another red flag, which is you can make this stuff up, right?
Well, yeah, we know now.
Chief administrative officer was the CFO of Lehman Brothers. You can make this stuff up, right? Yeah. I mean, come on.
It's a movie to me.
Right, it's a movie, right? Like, why are you hiring a CFO of Lehman Brothers?
Company
CFO,
that failed.
Not the janitor, right? The company that destroyed financial. Part of the failure was Lehman Brothers, part of the cost. So so you hire that person, and it's in your C-suite, and you have no risk manager. So it was bound to happen. I think the Fed just accelerated it.
And on top of that, I believe that the executives knew something was going to happen, because at the end of last year, from a couple of reports that I've read, they sold off a majority of their shares up to a couple days.
They did very recently, even a few days before this news broke, they were selling off their shares.
And on top of that, Forbes named them like. What was that article? The 5 days ago,
like one of the best banks or
upcoming banks or something like that.
5 days before
they removed the post off of Twitter. So it's like a lot of weird stuff going on. Right?
Yeah, when this was happening, the CEO of the bank was in Europe accepting an award for like some best banking, some award.
So how could this not have been seen? From you're a bank, right? You're not a small business where you don't have 100 million people looking at you.
Massive business, which is
exactly.
Which
but
is crazy,
you have like you do simple. You have a simple businesses that does say $1, $2, $3 million a year. You get audited by the IRS sometimes, and they dig through your stuff like. tremendously, right? But now you're talking about a bank that handles billions of dollars.
And it's not just some local credit union with 2 locations. The 16th
largest bank.
It's massive,
so, So I don't know. It's been now, it happened 2 weeks ago. Obviously, we have a little more information now. But then again, so much more information is going to be uncovered as to...
right. I mean, now people know where to look. So the reason SVB news broke even, right? Because if you and I had money in the bank, we wouldn't have found out. The type of clientele they have, they're very connected individuals, right? They're large institutions, VCs, right? Like venture capitalists.
A lot of big people.
So what happens is one person looked into it, and then the news spread, and that's why they had the bank run, right?
Well, I think at one point the CEO was calling his clients, not necessarily his clients, but the bank's clients, like the highest tier of clients, and telling them not to worry and everything was fine. But then something like this happens.
Yeah, so they had the bank run. Had they not had the bank run, they wouldn't have a liquidity problem.
Okay, but let me ask you this. I'm glad you brought that up. This happened because of the bank run, right?
Correct.
How long do you think they would have been able to sustain paying, going negative on paying interest rates and paying out?
That's kind of, it's a catch-22, right? So if you don't have a bank run, you don't have to sell your investments.
Right.
If you come to the bank and say, okay, I want to withdraw my $100 million. If I have 20 million in the bank, I can't say no.
Right.
I have to go sell the bonds that I'm selling at a loss.
Yeah.
If they didn't have the bank run, they didn't have to offload so much assets. But they shouldn't have had 70% invested in those assets anyways, in treasuries, in bonds.
Of course. No, I get your point, but say they're still investing.
There was still a problem. They were
still going negative regardless if people were withdrawing money. So it was still, red flags everywhere.
Yeah, because banks... by law, they're required to have about 10% of their deposits in cash, right?
Liquid, yeah.
I mean, that's well known. That's even a lot more conservative than it was before the crash, the 07, 08 crash, right? So they hold about 10% of their assets in cash. Everything else gets invested. Now, where they invest it and what model they use, that's all your risk that the bank has to assess and say, okay, if I need liquidity, can I get enough cash so I don't have to sell at a loss, right? And all these articles and debates are happening right now, and every bank that you look at, pretty much all of them are on the risky side now, except for JP Morgan Chase, which is crazy. Only JP Morgan Chase has a...
well diversified
and have better liquidity. So everyone else is kind of in that. They're not in the red zone, but they're also not like fantastic financially. So.
Well, I think one of the reasons why is now obviously in 2008 technology was still. It was out. It wasn't as advanced as it is now, of course, but information is so much more readily available to the average person. And instilling fear in people, it happens like that.
And fear sells.
Exactly. So it's like and it can spread like wildfire. Like you said that, a couple calls went around and boom, everybody knew about it. Like the morning of Friday, everything was fine. A couple hours later, the Fed took over. So that freedom of information.
They actually took over on a weekend.
On the weekend
news broke, it was the bailout.
Right.
I guess they don't want to call it, but the Treasury coming in and saying, obviously the Fed, FDIC, and the Treasury had to come up with a solution, right? So,
but they halted their operations first, right?
But the announcement was made on like a Sunday. I remember it was like a Sunday. They made the announcement. They were okay, and then Monday morning. I don't know if you remember, all the banks took off. Like their stocks started recovering because their announcement they made. But then Silicon Valley Bank never recovered. Their stock was, I think it was at $12.
Oh,
from 100.
They're not trading right now either. They're off the market.
They halted trade. But from a 170 down to like 12, I think, was the last one I remember today. That's
insane. So
and then Signature Bank was another one.
Signature Bank,
and there are a couple of European banks, Swiss.
So it's like
Credit Suisse and.
I don't know how to say it, like the shit's out the can now. So like everybody now
everyone is reading the footnotes, right?
Yeah.
So what happens is, due to how reporting rules are, I learned that I guess the banks don't have to declare on the losses that haven't come to fruition yet, right? So,
Right.
So even if you know your asset is at 80% of what you bought it at, like these bonds in this, they don't have to declare it because it hasn't been realized.
It hasn't been realized.
So
it's like your stocks. If you don't sell low,
it's a
you never
footnote,
lost.
right? It says our assets are at 70% value. But we're not selling, so it's not really a loss. So it's a footnote. No one was paying attention to
And it's always
those
questionable, right?
things.
It may be, right? Something like that.
But because they were forced, because of the run, they were forced to accelerate the sale. At some point, you run out of things to sell, right? Your investments
well,
run
they sold
out.
all their stocks, and then I guess recently I think HSBC invested or bought them out. Some type of news like that. Did you read into that?
There were 13 banks that the Fed made them make deposits into SVB, and that wasn't enough. I think it was $3 billion or some high number. They forced the banks to make deposits into SVB, not buy, not get a share.
Just give that money, basically.
Literally deposit money into the bank so they have liquidity.
Interesting.
And even that was about a week ago, I think. And even after that,
So what's the future of SVB going to look like? Like as a company,
I think they're
as a bank?
trying to separate out different portions of the loan business and the other aspects of the business, and they're trying to sell it off.
Dissolve it into a couple different things. Interesting.
Right. So they will have to. I mean, banks can pick them up pennies on the dollar, probably. But
Very
it depends
interesting.
what
Well,
portion of the business.
I guess this is a good segue for us to move into the interest rate hikes. Jerome Powell and the Fed meeting that happened just Wednesday, I believe, right?
Correct.
Wednesday, Thursday. Now, before this whole bank run and the Fed taking over, from what I believe at least, they were the market was expecting a 50-point hike, and then towards the end of the year just a 25-point hike. At least that's what the rumors were. Now and then once the bank failure happened, everything sort of just switched around, right? Everyone was like, "Oh my God, what's gonna happen?" Some people were guesstimating it would be zero. They're gonna stay flat just to see what in the world is going to happen. And some people were saying a quarter of a point, and that's what he did. He raised it another quarter of a point.
So the timing was very interesting because the Fed meeting was Tuesday and Wednesday, and Wednesday, usually on the last day of the meetings, they make the announcements on like what their decision is. A day before the Fed is when Janet Yellen, the Treasury, came out and said, liquidity, no problem. Banks are safe. Deposits are safe. So she had to do that to enable the Fed to do the raise, right? Because the Fed wants to raise the rates because of inflation. They want inflation to be at 2%, right? So it's a very aggressive. It's an aggressive target. And the Fed doesn't have 12 levers to pull, right? They have inflation. They can control flow of money. They can print more money, right? The day before, Treasury came out and said, government is saying everyone is safe. Now, she didn't say we're going to guarantee every deposit in the country. She said we're going to look and select which bank is deserving, I guess.
Very selective,
right? And it's important to say that at the end of the day, they didn't bail out the SVB, right? During the crash, what they're doing, they're bailing out the invest. Now, if you own SVB stocks, you lost everything. They're not going to bail you out, right? So the owners of the banks aren't bailed out, the executives aren't bailed out, and I guarantee you they'll go after all the insider trading, all the sell-offs a few days before the crash,
at least they
not making any announcements, right? So Yellen came out, said banks are fine, U.S. government is behind you, blah blah. Next day, the Fed raised the rate because if Treasury hadn't said that. Let's say if another bank had failed on Tuesday, there's no way Fed would have caused more issues. Because the more you raise the rates, you're devaluating those assets.
The more you're putting those banks at risk.
And you're going to put a few more banks in the red maybe, right? So you got to at some point stop. End of the year, Fed's comments indicated that they may only do one more raise. Beginning of the year, they raised it one time, right, a quarter, and then they said our target, they show a dot plot, and the dot plot was pointing to 5.1% target. So at that point, with even the beginning of the year, it was putting us at about a 4.5% Fed rate, right? Now that's important, and I say this a lot to my client. That's not mortgage rate,
Right.
That's the interbank Fed rate, right? That's a baseline for all the car loans, credit cards, and all that.
Right.
But of course, it affects the whole economy, and mortgages are part of it. So beginning of the year, we were at about 4.5 already. They raised it one more time this past couple of days ago, right? So now it puts us in that 4.75 to 5% range, and they didn't adjust their target. So that tells us there has to be at least another quarter coming.
At least another quarter, right. Yeah, and one of the things I think I mentioned at the beginning of the podcast too is Powell continuously stated that things are going to suffer, right? Specifically, employment rates.
Right.
But on the flip side, like I was saying, reality is somewhat different from numbers and what's being reported, right?
Right.
Reality, employment rates are lowest they've ever been in 50 years?
A very long
so
time.
It's like, how bad can it possibly? If we're the lowest that we are right now as far as employment rates, then they're looking to basically just obliterate the jobs and the employment rate. So it raises
they want
so
to
that
see
it puts
they
it
want
into
to see
effect.
like 4.5% unemployment.
Where are we at now? About 2?
We're in the low threes. Depends how you measure. Again, it's a political thing because they have so many tricky ways of measuring it. When they want it to look low, it looks super low. When they want it, so it's like it all depends who you ask. But same with calling the economy: are we in recession? Are we not in recession?
Right, depends on who you ask.
Right. So with all technical definition, we're in recession. But we don't see any effects of it. Right.
Yeah.
Unemployment is low. So unfortunately, the only way you can fight inflation is people have to stop spending money, right? How do you stop spending money? You lose your job. So they want to see unemployment in the mid-4s, and if they can see that, then slowly, then the Fed will stop raising rates, but they probably won't be lowering rates until probably next year.
Right.
In time for elections.
It wouldn't, of course, but it wouldn't even make sense for them to raise, and then right away drop.
Right.
As far
That's
as
the
I
other
know,
thing. They're not patient, right? They're not patient with the. The U.S. economy is not like a simple balance sheet. You don't just like raise inflation and next day you're like, okay,
I changed my mind. Right?
It's like a carrier and you have a paddle trying to change the direction of a.
Well, there's a lot of moving factors.
Right.
There's a lot of moving factors, and I mean, a lot of things are affected, like we spoke about. One of the things I remember, end of last year, they changed the way they were basing their decision on to raise the rate, something like that, where previously they would look at how inflation was and the CPI reports and the consumer price index was prior to the meeting. Correct me if I'm wrong, or I may be wording it improperly. And now they're looking to the forecast of what they're expecting it to be, and that's what they're basing their number off of.
So that's one problem why they keep raising the rates is because, and a lot of people in our industry, in mortgage industry, they point it. A lot of analysts, they point otherwise, but everyone says, well, you're in the industry, you want the rates to come down, you want to sell more homes, right?
Yeah.
But the way they look at the inflation year over year, right? So picture a graph that goes up and then it comes down, right? So you have this basket of goods, right? CPI, Consumer Price Index, and you take 1,000 different things, let's say egg, gas, milk, right? Everything.
Yeah.
You get housing. You get it all in one basket and you keep pricing them and you update this price from month to month. The problem is, well, we all know there was a lot of inflation last year. When you're comparing your CPI this month to last year, if you're comparing, let's say, March to March, you're still saying prices are going up. Because last March, we hadn't hit that huge increase, right? So that's why a lot of analysts in our industry, they say May will be the magic month. And that's what I've been saying also. So May 10th is the magic day, right?
Okay.
That's the day that we finally, our April comparisons compared to the height.
Right.
So we're gonna see that. Oh wow, it was a lot worse last year.
The actual differences.
It's actually getting better. So
Right.
so it's bad news, bad news, bad news until that window that you're comparing falls over something that was high. So now you're comparing a high to what it was last year high, and hopefully that's when the CPI is gonna take a big hit.
It's like when I speak to buyers nowadays,
Right.
they go like, interest rates were 3%. Yeah, last year at this time, right? But I'm like, look at it long term. Like, broaden your spectrum of what you're looking at. 6%, it's high compared to 3%, but you're not at 10%, you're not at 15%, so it's still somewhat doable.
And tell you what, as bad as inventory is, as competitive as our areas are, or market centers, right? It's still. I have had a lot of buyers who save more now on the purchase of the home than when it was 2.75.
Because of the purchase price.
Because of the purchase. First of all, if you have a buyer, let's say, who has 3% down, simple. W-2 employees, fixed income, meaning like there's nothing you can do with your income. You get a paycheck, you work somewhere, and there's no business to file to go higher income, right? You have a set amount, it's basic math.
Yeah.
You look at debt to income ratio, you're like, okay, I can push to 50%. This is what you qualify. That buyer in the market a year and a half ago, we would pre-prove them. They're very happy. Here's your rate, 2.625, right?
Yeah.
But they can't buy a house.
But so now go overbid 200,000 for the house, right?
But that person can't overbid.
Yeah.
They barely have 3%
They're at the cap
down,
right there, yeah.
Right? So, and then let's say they even took your offer, right? We would go into escrow. I mean, you remember this. We would go into escrow. Let's say somehow your realtor is a magician, got your offer accepted versus the other 47 offers with only 3% down.
Yeah.
We open escrow. Well, to get into escrow, you have to offer some ridiculous price, right?
Of course.
So now I order appraisal. It doesn't appraise. So I'm like, hi, sorry, you got to put another 180,000 down payment.
Cash out of your
whole
pocket.
down payment is 21,000.
Right.
You got to add another 200. So they cancel, right? So that's what I tell the buyers. I said, yes, absolutely. I wish you could have bought back then.
Yeah.
But either you buy a house at 6% or you never buy a house. So might as well get in if you can afford the payment and then refinance in 6 months to a year. And we think 6 months to a year will be the window where you can for sure refinance. I mean, barring any other massive failures in our system.
One of my favorite realtor talk quotes is marry the house and date the rate. I'm sure everybody has heard this before, but it makes sense, right? So if you're if you're marrying something or someone, right, you expect a lifetime of commitment there, right? So if you find a dream house you and your family can live in, then the rate just that's always going to fluctuate. The rate will never be set, but what's going to be set is your purchase price and what you're actually going to pay for the house.
And the beauty of having a mortgage is that it can never get worse, the payment. Right?
Yeah.
Unless you miss a payment, you get foreclosed. I'm not talking about that. But if you have rent, I mean, it's 100% certainty.
It's only going to go up.
It'll only go up.
No one's going to drop rates.
Right. Rent is never going to go back to $8 a month or whatever it was 200 years ago, right? So rent will always go up because even if we have a healthy economy, even inflation is at 2%, they're going to raise your rate at 3%.
Of course.
Right?
More money.
It's more money, right? So I always say, if you can afford the payment, buy the house, because if the rates drop again, which we think they will, now you're out of the marketplace again.
Yep.
You can't compete.
Now you can't compete again because everybody's re-entering. Speaking of rates dropping and all, supply and demand. I mean, it's been a very interesting issue because people are saying the housing market's going to crash, right? The outsiders, but us professionals, we take a look at it and say, only way it would crash if supply is through the roof, but then there's no demand. Right. But it's the complete opposite. Well, at least it's a little.
Yeah, as of February, we had about 578,000 active listings in the country. That includes pending. So it's not a house available for sale. It just hasn't closed yet. So I don't know what percentage of that is pending, meaning not available. But let's say they're all available, 578,000. In 2019, before COVID hit, we were at 1.2 million. And that was still a tough market. It wasn't like there was 6 listings on every street, right? So it was more than double. When people say, oh, my cousin's neighbor said it's going to crash, it's like '08.
Yeah.
'08, we had 2.5 million listings in the country,
Yeah,
right?
yeah.
And we don't have listings. We don't have inventory. Why we don't have inventory? Because that seller has a 2.5% rate.
Exactly, majority.
They don't want to sell.
Right. Again, yeah.
They're like, I'll add a room, I'll build a pool, I'll do an ADU.
Yep.
I can't give up my 2.5 and go get a 6.5% rate.
It doesn't make sense.
It doesn't make sense,
Yeah.
and my property tax is going to go up and all that.
Well, yeah, especially when they compare it to the same value purchase in the same area. Now, from what I've been noticing the past couple months is whoever is selling has a need to sell. They're moving out. Yeah, they have to. They're moving out of the state.
They're getting divorced.
Or they're getting divorced. They have to downgrade because all 6 of their kids are out of the house and they don't need 6 bed. It's a need that they need to do.
Most sellers we come across are empty nesters, or they have a very small house and now they have 2 kids, so they have no choice but to upgrade.
Right.
They're deceased. Right. It was 1 or 2 people living in the house and they're deceased, so the state sells the house, like their children.
Yeah.
Or it's newlywed, high-income individuals who they don't want to. Their standard of living would mean a $5,000 or $6,000 a month rent, right?
Right.
Which is ridiculous.
Yeah.
So might as well have a mortgage and buy something. So those buyers, the first-time home buyers, will always be there. People need to live somewhere, right? Now, investments go down, right? Investors are less. There's not emotions involved. The investment is all about numbers, right?
Yeah.
So they have to look at rents. They have to look at the rent roll, right? They have to look at rates. What's my cap rate, right? If it makes sense, they buy it. If not, they don't have to buy it. So investment is definitely down, but a lot of people are buying and adding value to the property. So they buy a single family, build an ADU, and that's how you justify the purchase.
Yeah, right now in at least in Los Angeles County, they've came up with a lot of new programs where they can add additions. At least I know in Glendale right now, you can develop a 2-story ADU now with permit.
LA banned a while ago.
Exactly, but I guess Glendale City gave the approval. So
and there's few grants. Every city has different. Long Beach has some grants. Los Angeles had a $40,000 grant. It ran out, but they replenished. I don't know where it is now, but they had a grant program for building ADU. Of course, with $40K, you can't build an ADU with this construction cost.
Right, of course. It helps a little bit, but one thing for sure too is how affordable housing is obsolete, basically. At least in our area.
There's nothing affordable.
I mean, I pulled some reports up. February median price point sold in Los Angeles County, $795,000, which is still down 5.4% year over year. Now that's a down number that we're talking about. So not everybody can afford an $800,000 mortgage. So and
that doesn't even exist in most of the areas we do business.
Right,
Like an $800,000 house in Glendale, let's say, doesn't exist.
Like a studio apartment,
right?
Maybe.
It's a condo,
right?
So it's difficult. It's very unaffordable right now. But also rents are unaffordable. So.
Everything is going up now. Let's sort of look into the future and cast a net. Where do you now? We've been declining. It's obvious we've been declining the past couple months. We're not going to crash, but there's been a decline in pricing, decline in sales, a lot of more canceled escrows,
correct.
Which I'm sure
buyers are more picky,
right?
Because they can be, right? So it's a beautiful market to be a buyer. I've had probably a high percentage of my, let's say, if you looked at my last 3 months, our companies, let's say, closed loans. A good chunk of them took advantage of this new seller incentives, right? We have, let's say, a 2-1 buy down.
The buy downs, right? Yeah.
So let's say I give the buyer a 6.5% rate. Let's say that's the average rate these days. So you give them a 6.5% rate. For the first year, the rate is 4.5%. For the second year, it's 5.5%. Huge savings for the buyer. And guess what? They can't even pay for it. We don't even have a mechanism for the buyer to pay for it. The seller pays for it.
That's what I was going to ask. Right. Yeah, seller has to pay for it.
Seller has to pay for it.
Oh, okay.
I can't even if the buyer said, I'm giving you 20 grand, we have no mechanism of doing that. Now, they can buy down the rate a little bit, but not 2%.
Right. Yeah.
You can pay a point, let's say, and your rate will be 6%, let's say, for example. But yes, sellers, now, November even, not too long ago, was a much better time to buy because the market slowed down so much, the sellers were so desperate.
Yeah.
As soon as we had a little bit of a help in January, rates dropped just a little bit. We touched the fives, right?
Yeah.
We're at 5.9999, right?
Yeah. Everyone's like, oh my God.
Rates are fantastic.
Let's party.
Go. Right? So I had surge of applications, right? Just me personally.
But what was that, like about a week that it stayed around there?
It was until the Fed meeting, right? So it was...
mid January or February.
It was towards the... Hold on, this last one was
March.
So it was like end of January.
End of January, right?
Yeah. It's about a month and a half in between or something. Yeah. But it took off pre-approvals.
Yeah.
The agents couldn't find homes, right? That's how many pre-approvals we had.
Right.
If I had to guess a number, we probably had like 30, 40 pre-approvals out in our company, right? Like the buyers couldn't buy. And then rates went up again, right? And then they continued to rise. And then we hit like the not all time, but this past, let's say 12 months, we hit like the October rates. We're again at the 7.5%, 7.8%.
Yeah.
And it all came to a halt again. So it shows you the demand, right? I don't even consider that a big drop in rates.
But the demand in buyers.
But the demand blew up.
Right.
Just because, now, most of these buyers, they could have bought even at 8%. They were qualified. Some of them couldn't, but it just shows the psychology. Buyers are out there. They want to buy a house. As soon as rates drop even a little bit, I think if we hit the mid-fives, it'll be a huge seller's market.
Seller's market, but will they actually sell?
They will, because the demand will pick up. Right now, the seller is hesitant because in LA County right now, I think the average is 75 days, right? Listing how long the market, the property sits on the market.
Right.
So the seller is hesitant because they're like, well, I want 1.8 for my house. If I list it, agent says, no, I think your house is worth 1.5. No, it's 1.8.
Yep.
So they don't want to list it. And if they list it at 1.8, no one is going to write an offer, and then they're going to say the market is dead.
Right.
No, because you're going based on an inflated value. It's unrealistic.
The 2022
21 pricing, even that was unreal, right?
Yeah,
so
of course.
So you can't get 2021 pricing anymore as a seller.
Right.
So seller needs to realize that.
Seller does need to realize that, and
it's a difficult conversation because you're talking about
it is because we're right past that. Well, I mean, not right past it, but it's been a couple months, but the sellers are still off, working off that mindset. Like, for example, if we call it expired, especially expired listings where, clearly the home didn't sell because of whatever reason, but then you're looking at the market and you're saying, you know what, Mr. or Mrs. Seller, I know why your home didn't sell. I'm just obviously not going to tell you straight up so that I can come in your door and at least get the meeting. But your price is way off. You're pricing 2021, my friend, and unfortunately the realtor didn't explain that to you well and wasn't confident in their skills to set it up correctly, but pricing is key. Homes still sell. In 2008 they sold, in 2009 they sold, in 2010 they sold. But
you can always sell your property. It just has to be done right. There was a duration of probably 18 months. Listing agents wouldn't have to do anything to sell the property. Sellers didn't even bother to clean up, right? Okay. So now is time you gotta, improve your curb appeal, right?
Everything.
You gotta paint the house. You gotta clean, just like before. It's back to the basics again, right?
The regular market.
The one thing people need to understand: nobody cares about the rate or the purchase price. Buyer cares about the payment. The first thing when they call, they're like, my realtor said, I want to buy pre-approved. How much would this be?
Yeah,
I'm like, it's this much a month. Right. So the seller needs to understand 1.8 million at 3% was a much lower payment than 1.8 million today.
Yep.
So you got to adjust it down. I'm not saying you have to give them the same payment, but you have to adjust it enough where it's
Well, it makes sense.
commensurate with the market, right?
With the current market.
So it keeps up with so your demand will be there. Otherwise, it's just going to sit.
Right. Now, factoring everything that we just talked about, right? The current state of the economy, the bank failures and the runoffs and the fear that's been instilled with everybody, this Fed rate, the Fed raising the rates and everybody just in like a bubble if they don't know what's going on. As far as a business, as far as a loan officer or a real estate agent, I don't know if you read the book before, but Shift by Gary Keller. Great book, and he states out a couple very interesting things. He says you have to be an agent for all times, right? You can't be just an agent during the good times, and then boom or bust, or like, oh, I don't know how to deal with clients during a tough time.
Right.
A couple of the things he mentioned, which I wrote down actually, is first one is you got to be creative with your financing. So if there's any realtors watching out there or loan officers, deals still do get done. One of the ways is you got to be creative with your financing. Obviously, I'm sure you've done a lot of creative financial options for a lot of your clients. It's just a matter of putting in the work and getting it done. If a buyer is willing enough to put in the work and fight for a deal and get it done and get all their financials situated, then it's on us as professionals to try to give them the most amount of options available. Right. At least that's what I feel like. Another one of the things he said is catch people in your website, and that's a huge one because I feel like not a lot of people utilize their website as much as they could. Right. We do a lot of social advertising and a lot of digital marketing, and we realize like simple things like that loan officers don't have or real estate agents don't have is like get a free pricing analysis of your home, and then boom, you capture the first last name of the seller and their email address, right? That's such gold information right now.
If you don't, and I tell it to our guys, right? If you're not active online, if you don't have a website, if you don't have strong Instagram presence, if you're not on LinkedIn, that's equivalent to a realtor or a loan officer 20 years ago not having a phone.
Right.
Like, how would you operate, right? It's a basic communication tool.
Yeah.
It's not a nice thing to have anymore. It's a necessity.
It is a necessity.
And you'll be surprised. Sometimes I want to reach an agent on a transaction, and you Google them, and you can't find their cell phone anywhere. Like, how's this? Is this 2023? Website is outdated. It still has the old brokerage's name. They've moved on like 5 years ago, right? It's an old picture. The email address
the headshot
is wrong.
From 10 years ago, right?
From 20 years, right?
That's the best.
And the phone number, you can't find the phone number. And you call the phone number, is that brokerage's like landline number?
Yeah.
How can you not have your cell phone?
It's actually very common, and I get so surprised, especially because the providers like Google and YouTube and Instagram and Facebook, they give us so much tools to take advantage of. Like a simple thing, Google came out with about a year ago, like Google Local Services. Right now, I'll probably research like one of the top 10 agents in California, for example, right? As far as sites. And I'll go incognito, and I've done this before. I'll go incognito. I'll search their location. I know like primary, they're in Glendale. They don't go anywhere. And realtor right after that, and they're absolutely nowhere to be found. But they're like the 10th agent in California. But it's like, how does that make sense? You gotta, everything sort of needs to be in balance with each other. Where you gotta have your presence here, you gotta have your portfolio here, and you need to be everywhere all the time.
No, absolutely.
And it's best of all, it's freaking free. So you have to take advantage of it.
These tools are all free. I mean, Instagram is free.
Exactly.
You don't have to run ads.
Nope.
And you have to have a strong presence.
Exactly. And simple things like video, and I know you do a lot of video and we do a lot of video. It doesn't take much. Just smartphones. Everybody has a smartphone nowadays. Right. You can just pick up the camera and just talk recent news.
Our smartphones are better cameras than any camera 5 years ago.
Exactly.
Like literally. $20,000 camera wasn't this good.
It's so I get very shocked, and then you get a lot of people like, oh, it's not working out. Oh, what's going on? The market, of course, they blame everything on the market, right? That's the market, the reason why they failed. But in reality, like, they didn't take advantage advantage of all the good stuff that's going around. Speaking of the market itself, one of the last things I want to quote from Gary Keller's book is you got to master the market of the moment, which sort of goes back to what we were talking about. Is you can't be that 2021 broker and come in and talk with that conversation. I'll sell your house in 3 days, right off the weekend. You know, you got to master the market of the moment. If you don't know what's going on, if you don't know about what happened with the Fed meeting, of what Janet Yellen said, of what Jerome Powell is saying, of what all these industry professionals are saying, all the forecasts, all the news, and you don't properly speak that language to your client, and I call it a language because it's a professional language that you need to speak in a way and like sort of baby talk it so the average person can understand, because a lot of average people won't understand certain things that we're talking.
Ultimately, I've always said it, and I always tell it to our loan officers. You need to be an advisor. You cannot be a salesperson, right? We're not standing at a lot selling used cars. So you walk in, I'm going to sell you a car. That's easier, right? You need to be a source of information. You need to be educated. A lot of people in our industry, unfortunately, there's no barrier to entry, right? How hard is it to get a realtor license,
which
or
is
even
why
a loan officer license? So everyone thinks, oh, it's easy. He's selling 2 homes a month. I'm going to go to sell 2 homes a year and make X amount. It's not that easy, right? Especially markets like this. They show it. And every good realtor I talk to, they're loving it. Of course. They say, market is getting cleaned up.
Everybody's
because they lost so many clients to, oh, my aunt is a realtor now, so I'm going to go with her.
Or they'll all do it for 2%ers,
Right, exactly. I'll discount it. I'll do that, brokers. Right? So now it's the people who took this as their career and have been doing it for a long time. And you don't have to be doing it for a long time. You just have to take it as your career, right?
Yep.
People who are serious, they're educated. Every morning they listen to the news. Like I wake up in the morning, first thing is
Barry Habib,
right? Like he's our God, right? So we listen to MBSs, right? Mortgage-backed security news. And then we look at the treasuries, and then we look at the bond market, right? Why? Because at 10 a.m. when someone calls me and says, should I lock now? I don't want to just flip a coin. I want to give an educated answer. Now, none of us have a
crystal ball
to say, oh, for sure this is the best. But at least I can give you an educated answer, right? Okay, this is what's happening. Let's wait for unemployment report that's coming on Wednesday. Then we can look at it, decide all that, right? So it takes time. It takes effort, right? I'm constantly on CNBC. I have my iPad next to my keyboard. It just I don't do anything else on that iPad. It's just CNBC all day, right?
Continuous.
Because it's important. Because when someone asks you, says, "Hey, what happened to SVB?" Right? You're educated. You're like, okay, this and this happened. They're like, oh wow, that's cool.
You can't give them that response of that's a great question. Let me get back to you on that.
Right? Let me get what's SVB.
Is that a
I was on TikTok all day. I didn't see it. It's like so.
No, and you said it great. Now is showing where it's like when the tide is high, everyone is doing great. But when the tide goes down, I forgot who said that quote. But when the tide goes down, don't be swimming without shorts on or something like that.
Exactly.
And that's where we're slowly going. Right, the tide is slowly washing away, and we can see everybody that's naked in the water.
Yeah, it's an uncomfortable time for our industry. But those who've been doing it for longer than 2 years, this is normal. There's no disaster, right? Because in 2018 and 19, properties didn't sell in 2 days. Agents did, brokers opened, they did 10 open houses. They would bring donuts and ice cream and taco truck to get people to come in. Right? That was the norm. The norm wasn't, let me list on MLS before I hit
Thursday
send.
And Monday you're in escrow.
I'm all over asking, right? You got to know how to negotiate as a listing agent, as a buyer's agent. No one negotiated anything, but they're like, should I put 100,000 more or 200,000? You're like, put 200. Okay.
The highest price wins.
Right, highest price wins.
It was auction. It was literally an auction.
No contingencies, nothing. It's wild west.
I mean, we worked together on a couple deals during that time, and I'm like. And I'd call you and like, Artin, should we do this? Like, I'm scared to remove this. Like, I'm like, the property's a disaster. Should we remove the thing? The inspection.
There's no roof.
He's like, bro, do you want to get the listing or no? I'm like, oh, I mean the sale. So absolutely. I mean, it was, and that's what I tell everybody.
And that wasn't normal.
Don't get accustomed. That was not normal. I'm like, do not.
But a lot
base
of
your stuff on that.
people we run into, they started in the last 2-3 years.
Yeah.
Why? Because they saw, it's so easy.
Yep.
And by the time they got licensed, got a hang of it, that period was over. So now they're like, this is the worst market.
Yeah.
It's not the worst market.
I came in at the worst time.
We had 18% interest rates in the 80s.
Yeah.
Even before COVID, we were at 5% almost.
Yeah.
It wasn't a 3, right?
Yep.
The 3 was never the norm, right?
When's the last time we've been in that range? Just curious. Never, probably?
We hit all-time lows in the 2s, right? That was all-time. I think we touched 3s, right? 4s a lot, right? We've been in the 4s.
Yeah.
3s, I want to say maybe in 2000, it was when we were in recession, maybe.
Before?
No, after the crash.
After?
We touched like the 3s and the 4s. I want to say maybe 2015.
So either way, it's
yeah, like I bought a house in 2010, and my rate was 5.625. That wasn't too long ago. It was
and you're really happy with that rate. Let me bet.
I was very happy.
Yeah.
And because it was a credit crunch after the crash, no one was funding loans.
Yeah.
So I tell people, I'm like, look, rate is high, but we have no lending problems.
Right.
We have actually 100 times more programs
Better options
than we
now,
did
right?
a few years ago, right?
Yeah.
We have stated no doc, bank statement only. We have down payment assistance, right?
Yeah.
You have investment loans, no income. So, there's no issues with
the funding
of
itself.
loans, right?
Yeah.
For those that were in the market, in the business back then when the crash took place, they will tell you that there were websites. They would wake up and check the website, and it would have the names of all the lenders, all the wholesale lenders, and one by one it would show like a red, like they're done,
oh my
like
God.
closed, right? My partner would tell me, because he's been in the business longer, right? He's like, Friday we would high five each other. We're like, yeah, we have 7 escrows, we're funding. We would sign loan docs. Come Monday, the company, the lender had shut down.
Oh my goodness.
So you can't fund the loan, right? So we don't have those issues right now, even though rates are high. Rates are high. You're going to refinance.
All right.
So,
well, I guess wrapping this all up, it's you have to be the knowledge broker. You have to know what you're talking about.
Knowledge is power, like
knowledge,
this.
Yeah, and just convey that message in a smart way, where first and foremost you don't get in trouble by overcommitting and under delivering with your customers, and
don't lie.
Of
right?
course, I mean
don't,
that's like that. I feel like that's something we don't even need to mention. But of course, don't lie. Don't talk in previous terms, right? Everything is about the now, what you can do now.
My favorite line is, and I don't know who said it, maybe you know, 2 agents, is when you talk to clients, don't have commission breath. They can smell it.
They can
right?
smell it, yep.
So don't make it about, oh my God, I got to sell this house. Make it about, what's the best choice for my buyer?
For your client, yeah.
There's a lot of buyers I've told them, this is not worth, you're stretching too thin. Let's back up. And I have one right now in escrow, which I'm not going to name, but we got escrow accepted. It was $850 purchase price. I could do the loan. They were getting stretched so thin that between the taxes they had to pay to qualify and everything else. Me and agent talked to them, and he said, look, this is just not the right house for you.
Right.
Let's buy something. So now they're in escrow for $750. That $150,000 made a difference for them.
Right.
That was $1,000 a month right now.
Yeah.
So don't have commission breath. They'll forever, value our honesty.
Exactly. Long term, it's going to work out a lot better.
Now, agent makes
for
less
you.
commission. We make less commission. But the buyer is in a more
long-term
secure
relationship. Exactly. Right. Well, if you take care of them
and
now,
they won't
with
default.
Everything,
so
exactly. And who are they going to blame? Right?
Right.
They're never going to blame external factors.
No,
it's going to be
they're always
going to
say they pushed me into it.
Yep.
Right.
So, I guess let's wrap this up, man. I feel like we had a lot of great conversation. We hit a lot of the major topics that are going on in the industry. I hope our viewers got a lot of takeaway from this. We touched on a lot of different factors as far as our personal business and what to do with it. External stuff. Hopefully, gave them some good information. Anything you want to add on before we close? Where can people reach you if there's anyone local?
Yeah, so I'm everywhere to be found. I'm very active on Instagram.
You're active online.
Yes,
so.
Artin the Lender. I'm on Instagram.
There we go.
And then optiononelending.com is our website. And we're in Sherman Oaks. We're very active in all of San Fernando Valley, so anywhere from Pasadena to Calabasas, pretty much we're active.
And you guys loan in other states, right? Was it 30-something
Correct.
states?
We have some investor programs that we can lend in over 30 states.
Okay,
and we're
that's
getting
good to
actually
know.
licensed in Florida now, so we can
very
do
nice.
actual, just regular
Actual
loans
loans.
as well
Very
in
nice.
Florida because demand is good.
Yeah.
Hopefully for our next meeting, we won't talk about the Fed anymore, and they've stopped it. Hopefully by then we have, I think we'll look back and say, okay, CPI went down, inflation is down.
Everything's in the norm.
So I think that would be my prediction for our next session.
Well, hopefully, hopefully the whatever happens is doesn't hurt anybody too bad, and
Right.
businesses are very smart about their options and about the choices they make moving forward. And as always, we hope that you guys got a lot of content from our podcast and from our website. So tune in next time we discuss what's going on in the industry news. Take care now.
Thank you.